back with one of the best money men in the business, Switzer.
Welcome back to Switzer on Sky News Money. There's a new abbreviation on the block that the kids are using called FOMO, which means fear of missing out. And according to Investors Mutual, it's the fear of missing out on the next big thing that's dragging investors away from fundamentals and towards momentum-type stocks. But fundamentally based management, IML, is sticking to its guns and staying away from fads. To find out why, I've invited IML's small cap portfolio manager Simon Conn on the show. Simon, thanks for coming on the program.
Yeah, pleasure, Peter. Pleasure.
Now, you've actually provided the table. We might go to that table first because it kind of sums up what you're saying. Is that well, tell me what you're arguing.
Well, no, basically, I mean, the market, the small orders has run quite considerably since the beginning of the financial year. But what we've seen is that the stocks going up, it's quite a narrow basket of stocks which is driving that index gain. Yeah,
and there's a lot of stocks in the small orders. So for a narrow base, it's kind of, you'll make a point that you've got to be careful because these are fad stocks or concept stocks.
Well, it's very thematic. Yeah. You know, the theme around China particularly has been very strong, either with the resources and the consumer staple sectors exposed to either the Dago market or exporting the consumer staple goods to China.
Costa Group goes to China, been doing
Blackmores, Bellamy's, and they've been, investors are continuing to bid those small basket of stocks up, and that's creating, you know, great gains in the index, but it's very narrowly based.
And it's a momentum trade, and we've seen it with Blackmores before, which I think is a great company. When it got to 98, I thought it looked like a good buy. At these elevated levels, it reminds me when it got to, what, 220 or something like that.
3 years ago,
it didn't last.
Trading at $200, you know, everyone was very excited about the theme of selling more vitamins to China, and then it, fell back down to $100 this year. So it has been very volatile over the last 2 to 3 years.
Okay, let's go to the table and just show us what you're actually seeing. Okay, so I think we can get that up on. All right, so there it is there. Okay, so it's not all that easy to see, mate, but running through it, we've got Aitken at the top. Over a 1 month period, what's it up?
27%.
Yeah.
In 1 month.
Yeah, and this is a stock that's often going down by a large amount, and now it's going up by a large amount.
Well, you'll recall in January they had an earnings downgrade and delayed some of the earnings growth that they were anticipating. The stock fell something like 40 to 50% in 1 month. So, it's proved to be very volatile.
Do you like the company?
Look,
not these prices, but do you like the company?
Look, the company's okay. I mean, we're not a shareholder. We haven't owned it since it's listed. I've not got anything against it, but the valuation is extreme. Trading 146 times PE. Yeah. It's ritzy. It's way up there.
Okay, let's go to Altium now. It's up 10.9%, which is quite sedate.
It's been the laggard in the last month, but over the last 3 months, it's up 37%. Yeah. Trades on 34 times. It's very expensively priced. It's done really well under the new management team, renewed management team, and it's delivered some growth. But I think the point here is the share price has gotten way ahead of the earnings growth it's been delivering, and it's pricing a lot of good news.
Okay, so a company like Afterpay, NextDC, WiseTech, these are all stocks that you think are momentum or fad stocks? What do you want to call them?
Well, I think it's a momentum play. They have they're delivering either revenue growth in the case of Afterpay or earnings growth, but the share market is willing to ascribe a significant multiple, particularly in the case of something like WiseTech, which it looks like it's a good solid business, but it hasn't been listed that long. We haven't seen it trade through a cycle. And the market is ascribing a huge multiple off a smallish base, and they're willing to pay $3.5 billion for that company.
So when you look at these companies, Simon, clearly you're saying to yourself, well, there's obviously market support for the company, but when you do your fundamental analysis, are you saying, let's take a company like Bellamy's, which was a real struggler, 2 years ago, and cost a lot of people a lot of money.
Well, Bellamy's is a great case in point because it's a stock that listed at $100 million market cap. It ran all the way up to $1.3 billion over about 18 months to 2 year period. I think I spoke about it on our investor roadshow back in March. When we saw the managing director, the chairman both resign or retire, had issues around China regulatory fears. They were overstocked, and they had significant issues. There was a fear that they actually might have to go broke at one stage because they were overcommitted to the inventory. Share price fell. We've had a new management team come in. Demand has picked up again, fortunately for them, and the stock's run again. So, but it's pricing in at $1.4 billion, so it's back to where it was previously. But 38 times. It's a company that's very exposed to one channel, the Chinese export theme, and it's pricing in a lot of good news at these prices.
Okay, so if an investor's out there now and they're toying with the idea to jump into any of these companies here, what would your advice be to them? Don't
chase the momentum. Don't chase, just because the stock price has gone up, it doesn't mean the company is necessarily a great company or something that they should invest in. At the end of the day, and we've seen this through cycles, Peter, it always comes back to fundamentals. It's always about valuation. And in this market, particularly over the last 3 to 6 months, seems to be valuation doesn't really matter so much. It's really about the earnings momentum. The market has become very myopic, very short-term in its focus, and it's really about the last data point. So if we've seen an EPS upgrade or a positive revenue announcement, stock continues to go up, and this continues to fuel the fire.
Look, because it's a small ordinaries, and a small group within the small ordinaries, you couldn't blame ETFs for this, because not many ETFs would be chasing this. There might be a small ords ETF,
I think
but they go for the whole index. They wouldn't just pick out some momentum stocks.
Well, I think you have to look at the market participants, and I think a lot of people are very short term in their focus. No one's really willing to look 2 to 3 years out. Everyone's very short term focused in the market. So it really becomes what was the last data point? What's the next data point going to be? Do
you think a lot of this is driven by fund managers who want to get in and then get out? Like if they bought Bellamy's where it was and as a contrarian play, they're looking at a very good profit from there. A fund manager would be inclined to take the profit, wouldn't he?
Well, you'd think so on a fundamental basis, particularly as valuations. But the issue we have at the moment in the small cap index is stocks such as A2 Milk, which is capped at 5.2 billion. It's about 3.5% of the index. I think it's the largest small cap we've ever seen.
Yeah.
A lot of managers now believe that feel that they have to own some position there. So if they get new money, they'll continue to invest in that stock. So it becomes a self-perpetuating momentum story, and they continue to chase the earnings there, chase the share price. Sorry.
Okay, so if you had to sort of make some key observations about what you've seen in the market now, what are the key messages that you would put out to our viewers?
Look, I think people have to be very cautious in terms of some of the companies that have appreciated in share price quite phenomenally, particularly over the last 2 to 3 months, and be very cautious about what they're pricing in. I think investors need to look at the fundamentals of the stock. Think about what the company's earnings capacity is and appraise that, and understand what's driving the earnings and really what they're paying for today in terms of the share price. Some of these companies, and I think the article you're putting up on the screen, the aggregate market cap of those 13 stocks is $25 billion, and yet they're trading on a PE of 50. Some of these stocks in the resources sector, we haven't even talked about the lithium stocks, but some of the resource stocks, didn't even make money last year. And they're at early stage of developing their deposits. So, the long-term commodity prices for something like lithium or cobalt, which are quite niche commodities, they will be very volatile.
Well, Simon, a strategy that's often worked for me is when you see quality companies not performing as well in the market, it's often a good buying opportunity. So are there some small ords stocks that you really like that at the moment are being ignored by the momentum players that you think, A, are good fundamentally, and when there is a broader based improvement in the market, mainly because maybe Australia grows faster as you get across 2018, what are those companies that you would
I think one of the ones we've talked about on the roadshow just more recently was Southern Cross Media.
Yeah.
So a leader in the media sector. So it's a leading radio operator in metropolitan and then regional areas, and also the regional rebroadcasting of Channel 9. Stocks trading on 9 to 10 times, yielding close to 7% fully franked. Excellent management team led by Grant Blackley. Seasoned media executive.
Almost Channel 10 boss.
Yep. Good balance sheet. I think the debt's been reduced considerably, and those sort of multiples at 7% yield, I think you get paid to hold it. There's always the spectre and opportunity for some sort of consolidation to happen now that the media reform laws have gone through.
Yeah.
So I think you get that optionality through on the upside.
Yeah. Does a company like that suffer because there's so many question marks around the media, or is the argument when the cross-media laws will actually create opportunities for a company like this? I think
this is typical of what we're seeing in the market. What's happened with this stock is that the AGM, the first quarter, was a bit soft. They were cycling a period where they had the federal election last year and the Olympics, which led to boost in advertising expenditure. Their first quarter was a bit soft. They're saying for the full year they're still on track for growth. And I think the short-term earnings disappointment or comparable period decline leads the market to sell off the stock because the earnings momentum is not positive. It's not hitting all those quantitative characteristics a lot of the momentum type investors look for. And people buying that stock today can get a 7% fully franked yield.
Yeah, which is a good one. All right, Simon, great to see you.
Okay, great.
That's
Thanks, Peter.
Simon Conn from Investors Mutual. After break, why make the move to the UK? The founder of Crest Apartment Hotels up next with why he's hedging his bets on the UK market.
This is Switzer, exclusive to Sky News Business.